According to a recent report, we are seeing that 94 banks are at serious risk of default, of bank runs, of liquidity issues. Why? Well, because we have too much uninsured deposits. Right now, banks like State Street, Citigroup, even JP Morgan Chase, and BNY are all at serious risk. So if you think, oh, don't worry, I'm okay because I have my money in the big banks, they can still fail. So I'm going to break all this down in just a moment, explain what is going on, what we are seeing at the consumer level, and why this is deeply concerning. So again, I'm going to break all this down in just a moment, but all I ask is one thing. It takes 2 seconds. Go ahead, hit that like button if you enjoy these daily updates. And now let's begin. So yes, this is very, very concerning. 94 US banks are at serious risk of bank runs, this includes BNY, State Street, JP Morgan Chase, and Citi. Now, this report came out just recently, but I want to read you a little bit of this article, okay? And here's the reason why. This study, this was an analysis that was done from Florida Atlantic University. It says it finds that billions of dollar banks in question, which includes 7 U.S. financial giants, all have reported a 50% or higher ratio of uninsured deposits to total deposits. Now, we talked about this just recently. I told you there is about $19 trillion in total U.S. deposits, 7.7 trillion of which is uninsured. The U.S., again, I just want to paint this picture for you. FDIC insurance, okay, this is the United States insurance policy for all of our deposits. They have about $120 billion in their reserves to pay out people that are uninsured, right? Or pay out people that are insured. So there are $120 billion, okay, but yet we have $7.7 trillion in uninsured deposits. The math does not add up. But let me show you how severe this is, okay? Look at this right here. It says right here, the first bank failure of the year is First Republic Bank in Pennsylvania. They were number 87 on the previous quarter's list. Well, they had a ratio of 51.5, okay? Keep that in mind, 51.5, and yet they went under. Look at this right here. Says the university's liquidity risk from exposures to uninsured deposits index shows BNY Mellon has a 100% ratio of uninsured deposits, followed by State Street Bank at 92.6, then Northern Trust at 73.9, then Citibank at 72.5, HSBC Bank at 69.8. You got JP Morgan Chase at 51.7 and US Bank at 50.4. That is crazy. That is crazy that we have that much uninsured money. Keep in mind, some of these banks, Citigroup, BNY, State Street, JP Morgan Chase, a lot of these people that are putting money in there, they might be worth millions or billions of dollars. But it's the smaller banks like First Republic, okay, that when they have the average person is just a average Joe, right? It's not a billionaire. That's an issue because people that are just regular everyday people need that money to survive. Well, I want to show you this. Here's what's happening now. And I hate to say this, but we knew it was coming. Look at this. It says credit cards. My spending limit was slashed by 90%. This isn't anything new. Listen to this comment that I received just recently. This person says, and I quote, I just had my credit line on a Visa signature card lowered by $12,000. It went from $17,000 to $5,000 without much of an explanation. All they said in a letter was that it was after careful review of my account. That's just pretty standard right there. It's not like I was planning on spending the full $17,000, but this was my emergency card. I told you guys this probably a few years ago. I told you to be careful, because if you are using a credit card for an emergency fund, all that card issuer has to do is just cancel it. All they have to do is just lower your limit. And then how much of an emergency fund is that really? But this is what is interesting. Credit card companies, and I've been looking a lot into this, more and more credit card companies are now canceling, your account if they deem that is an emergency account. And how do you know if it's an emergency account? It's simple. There's things like tire purchases, one tire purchase over 2 years. Things like, there's a service bill for, let's say, a HVAC technician. That would be an emergency. Something like maybe a hotel room or a tow charge, right? In the middle of nowhere, right? All of a sudden, no vacation, nothing. Just middle of nowhere, tow charge, and a hotel bill. That could be an emergency. That's how creditors know. But here's what's interesting. They don't want you using them as a backup. And here's the issue. According to recent reports, if somebody uses a credit card for an emergency and they max it out, there's a very high likelihood, over 75%, that the person does not make a payment to that card. Yeah, because that was an emergency and they don't have the money to actually pay it. Yeah, that's an issue. But this is what we're seeing. So if you have a credit card with BNY, you have a credit card with State Street, Northern Trust, Citibank, HSBC, JP Morgan Chase, or even US Bank, just understand that they are now putting more pressure on people to pay. They're putting more pressure on people to stop spending. I've actually received, so I do have a card through one of those banks, and I actually received a letter just recently, and this was more of a how to pay off like your debt. One of the things I do quite a bit is I'll rack up, the card, I'll use it, and then at the end of the month, just pay it off. Well, here's the issue. They still send it out. So they're sending out all these letters trying to tell you, this is what you need to do to stop overspending. This is what you need to do to pay off your credit card early. Some little tips, right? Work more hours, save some money, right? All these little things. Try to get your auto loan. Try to get a month off of the auto loan so you can take that money and you can pay a credit card. Interesting. They're telling you don't pay the auto loan, pay the credit card. Yeah, interesting, right? But that's kind of what's happening. But here's something else I want to show you. And this is going to be very scary, but I want to show you this, and then I'll explain. This article right here from Money Watch says 70 million people just had their credit card limits cut or accounts closed. That right there should be scary, okay? That should be frightening. But let me show you the date. This is July 22nd, 2020. Okay? This is 4 years away. Okay, we've already gone through this. 70 million people had their credit card limits cut or accounts closed. Why am I showing you this? It's because of what they say in the article. Okay, look at this. It says card issuers are paring credit card limits to avoid potential losses from cash-strapped Americans, many of whom could struggle to make payments as the economy reels from the impact of the pandemic. It goes on to say, that means that more cardholders should expect to have their credit cards limit slashed or have dormant accounts closed involuntarily. It says consumers should be considering moving small recurring payments such as their monthly fee for a streaming service to a dormant card and set up automatic payments. That way a card remains active and available for emergencies. Again, the word emergencies. This is the reason why. Okay? And again, this was 3 years ago, 4 years ago. And here's the issue. This is exactly what we're seeing. People are getting their accounts shut down because they're considered emergency cards. Okay? 94 banks are at risk of serious risk because of potential bank runs, liquidity issues. And this is all before we have a commercial real estate crisis that's going to come and hit us in the next 6 months. I want to read you one last thing. Here's a comment that I received just recently. This person says, in big bold letters, warning to all. I recently got a Lowe's credit card with 0% interest for 12 months. and it ruined my entire credit. I spent $8,000 on materials for renovations, but that also was 100% of my credit line. Then I got multiple letters about a month later from my other card companies informing me that recent activity shows that my credit usage is too high, and as a result, they will be lowering my available limit. Person goes on to say, don't fall for this 0% scam. Here's an issue. When you have a 0% credit or 0% interest, right? And let's say you have, $8,000 in as a credit line. You can go and spend up to $8,000. And as long as you don't go over, as long as you don't miss a payment, right? Then there will still be 0% interest. You just got paid off before the 12 months. Simple. But the issue is if you keep it maxed out for months, the issue is they're going to see, all your other credit card companies are going to see that, oh, you have more debt now, right? Your income didn't go up. You have more debt. Now you have to service this debt. It creates an issue. And so then they lower your credit limits so that they don't get stuck with the bag, holding on to it for you. So again, yeah, this is an issue, but this is something that many credit card companies are trying to do, give you 0% interest. You know why? Because they are banking on the fact that you will either go over, you'll miss a payment, something will happen, and it will screw you up where now it's not 0% interest, now it's 22, 23, 24% interest that you're going to have to pay on all that money. So again, these companies, they're smart. They understand that there's a lot of risk on them, but at the same time, they have to figure out a way to start making money. So that's where we're at this time. If you have any questions whatsoever, please ask your questions down in the comment section below. But that is what we know as of today. So again, thank you guys for watching. Consider subscribing, and I'll see you guys on the next one.